how we frame it. The meeting is being recorded. We did think about whether we ought to postpone it because of everything else that's happening and everything else that you all have in your plates. And we really came around to the belief that this is actually a really good time, that it's not off point. It's very much on point, because what we are seeing both in terms of COVID and in terms of the movement for social justice on the streets is the recognition of inequity, of racial inequity, and of the fact that we don't have the resources to address those inequities. So, that we decided to just go ahead with it at this point and take advantage of that opportunity. we're going to do some quick introductions, and then I'll do a little bit more framing of what we want to accomplish today. The majority leader wasn't able to be here today, but she sent a video that we'll play in a few minutes. So let's start with introductions. If we could just do for electeds, name, pronouns, and the district that you represent. And then for everybody else, if you could introduce or announce yourselves in the chat, that would be great. So I'll start. Sushila Jayapal, Multnomah County Commissioner for District 2, representing North and Northeast Portland. And I'm just going to call folks as I see on my screen, and if I miss you at the end, please jump in. Rep. Doherty.
Hi, Margaret Doherty, represent House District 35, which is Southwest Portland and Tigard, Southwest Portland.
Thank you for being here. Rep. Nose.
Good morning, everyone. State Representative Rob Nose. I use he, him, his pronouns, and I represent Inner Southeast Portland, House District 42.
Commissioner Myron.
Hi, Sharon Myron. I am Multnomah County Commissioner for District 1, which represents all of Multnomah County west of the Willamette and also inner east side south of I-84 and out to Cesar Chavez or Southeast 39th.
Rep. Sanchez. You're on mute, Rep. Sanchez.
I always forget about the silly mute thing. Ana Sanchez, House District 43, North and Northeast Portland.
Thank you. Senator Burdick.
Jenny Burdick, Senate District 18, she, her, hers. My district includes West Portland and Tigard, including downtown Portland, where we're getting all of the federal secret police, excuse me.
Good morning. Rep. Lawrence Spence.
Good morning, Akasha Lawrence Spence, House Representative, State Representative for House District 36. That's downtown Portland, down to the South Waterfront, all the way to OHSU, back up to the Northwest and Southwest Hills, including Multnomah Village and Hillsdale. Rep. Salinas.
Good morning, State Representative Andrea Salinas. I represent House District 38, which is Lake Oswego and Southwest Portland, and I use she in her pronouns.
Rep. Mona Sanderson.
Senator Lori Mona Sanderson, representing Senate District 25, Gresham, Troutdale, Wood Village, and Fairview.
My apologies, Senator.
No problem.
And have I missed Commissioner Stegman?
Good morning. Lori Stegman, Multnomah County Commission, representing East Multnomah County.
I think that's everyone. Have I missed any of the legislators or my colleagues? Great. Well, thank you all. And again, thank you for being here. So just a quick, we have a lot to cram in, so I'm not going to say a lot, but just a couple of things to say by way of framing these sessions that we've set up. The first is that these are incredibly complicated issues, and we're obviously not trying to resolve them in 3 sessions. The idea is really to tee up a conversation and have these sessions be a catalyst for additional work. The intent is to provide some level setting in terms of information. Some of you know so much about our property tax structure. Some of you know a lot, some of us know a lot and need refreshing, and some of us are brand new to it. So the idea was to level set by providing some history, how we got here, what it looks like, what the impacts are, and then a discussion about moving forward. We don't have a specific set of concepts or a specific timeline in mind. That is all up for discussion. It could be that this leads to the development of some concepts for 2021, or it could be that it leads to a path towards concepts for 2023. That's really up to you all and where you decide to take it. The other thing I want to mention has come up a couple of times. This is a gathering of Multnomah County legislators and commissioners. That's not because the intent is to come up with a Multnomah County specific solution. I believe, and I think most of us believe, that a statewide solution is what we're looking for. So again, this is just a teeing up with Multnomah County as a jumping off point. But then as we go through today, next week, and the week after, we will be providing information about statewide impacts, and we'll also be providing some information about what it looks like in other counties, just to give a sense of sort of the range of impacts and a sense of why it's complicated to try and figure out a path forward. So that is the framing. With that, I'm gonna cue a video from Majority Leader Barbara Smith-Warner.
Good morning. Thanks everybody for joining us today in this important conversation about Oregon's property tax system. I'm sorry that I cannot be there today, but I will be there for the next two conversations. When I was doing the Student Success Act work, the tour around the state in 2018, as well as the policy in 2019, we had a lot of conversations about how property tax could or should play into that tax reform. And ultimately, I used to tell people, let's deal with corporate first, and then we can deal with property tax. So I'm so excited, and I want to particularly give a shout out to Commissioner Jayapal for continuing to push us forward and bring us together on this front. So today you're going to be hearing from a couple really knowledgeable folks about our property tax system. It is quite Byzantine, so listen carefully. It takes a few times, but ultimately it's important that we really do all understand it. After today, in the next couple of sessions, we'll learn about the inequitable outcomes that have come from it, and then kind of talk through and brainstorm through some of the proposals and suggestions about how to change it and their pros and cons going forward. So it's very complicated, as I mentioned. It's also, it is an issue, frankly, that generations of political leaders in this state have avoided dealing with. So, especially at a time when we are looking at a very uncertain fiscal future, it's really important for us to get a handle on it so that we can use it to point our resources, to use our resources most equitably, share them with people who need them the most. So I hope you get a lot out of today's session. I look forward to seeing you in the next sessions, and thanks everybody for being here.
Well, thank you, Majority Leader Barbara Smith-Warner, for that in absentia. And we are now going to dive into the presenters. You've got the agenda. We're going to start by talking about the history of how we got here. We're going to talk about the system as it exists, statewide consequences, and implications for Multnomah County. And our first presenter, I think, needs no introduction to most of you, Paul Warner.
Thank you, Commissioner, and it's a real pleasure for me to have an opportunity to participate in this project. It's something I've been very interested in for a long time. I first moved back to the Northwest in 1989, just prior to the passage of Measure 5. So this issue's been out there, and one that I know is legislators have looked at. I know local officials have been very concerned about over the years. Certainly our Senate Finance and Revenue Committee, under leadership of Senator Burdick and later Senator Haas, have really focused a lot of attention on this issue. So a lot of what I'm going to say here is kind of opening is based on some of that work that the committees have done over the years and some of the perspectives that they've gained, I think. The first thing, my role here is to go back to the pre-Measure 550 world. And really to do that for a couple of reasons. One, I think that the main reason is to give you a policy context, what was going on at that time. And really, I think the message here, it's important to look at what was going on at that time. What were the factors that drove the state to that decision? And I think that it should give you the sense that these kinds of decisions are based on what was going on at the time, and many times should be reviewed and looked at into how that may differ from where we are now. The second element I think that's important here is we can talk about the components of that system, and we'll talk about them kind of a real high level, but the next question that comes up, if you think about how the system might be improved or changed, I think an important point to look at are some of the elements of that pre-Measure 550 world. Not that you want to go back to it, but perhaps you want to look at some of those elements and see if they're worth restoring. So the first element about that system, if we could move ahead, is it was a pure levy-based system. This operates much differently than the way our system works today. And that levy-based system, and you see NCSL has a chart of states and what they have in terms of their overall systems, whether they're rate-based or whether they're levy-based, and it's pretty much half and half. A lot of states still have a levy-based system. But the way that works is it's really the budget that drives the system under a pure levy-based system. Local officials or for that district determine what that budget is, and then they determine a tax rate based on that budget. You apply that budget to what your tax district, what the taxable property is in your district, whether it's a special district or a county or a city or a school district in those days. So you apply the rate to that, divided by the total taxable property. So if you've got $1 million budget and you've got $100 million in taxable property, you've got a 1% or $10 per thousand tax rate to apply. Now that tax rate applies to the real market value of each of the individual properties. So that's how people's tax is determined. They get their share based on their share of market value in the taxing district. A couple of interesting things about that system is, one is that exemptions don't directly influence overall revenue under that system. So if local officials have the authority, if they're given the authority, or if the state imposes some exemptions within that tax district that reducing the amount of taxable property, you would simply apply the levy to a smaller base. So you're still raising the same amount of revenue, but in order to raise more revenue from that smaller base, you have to have a higher rate. So it's the rate that's the variable mechanism there that moves the revenue up and down. So exemptions, it's a whole different dynamic, I think, when you're looking at exemptions as a policy tool in that kind of environment. Then lastly, most levies do have some kind of a constitutional limit. And in our pre-5 and 50 world, it was 6% annual growth. And you know, one thing about these set percentages that always makes me nervous, you look at 6% today and you think, wow, you know, I mean, that's, you know, with 2% overall inflation, that should be something that should be manageable in most districts. However, at that time, if you go back to the 70s, late 70s in particular, we were running 8, 9, 10% inflation rates. And this was also the time when Oregon's population in migration was very strong. Governor McCall, famous visit but don't stay saying during that time. So there's a lot of pressure on local governments and to try to stay within that 6%. If you go outside that 6%, then you have to go to voter approval. And that, of course, became a major obstacle in some districts in order to do that. So those are the key elements of that system. Now, if you look at the results in terms of individual taxpayers, we'll look at the next slide. This was probably the most obvious factor in driving the pressure from voters to change the system. And we had very high property taxes relative to other states in the nation. Our property taxes were 5.1% of total personal income. That was 5th highest in the nation, the 7th highest if you look at just on a per capita basis. So our taxes were relatively very high. And of course, we all know the reason for that. We didn't have a major statewide consumption tax like most states do. But nonetheless, property owners had a significant burden on them to try to finance the system. The other way of looking at those tax rates and high tax rates is statewide. In 1990, the statewide property tax rate, and this is percentage of market value, was $26.61 per $1,000 of real market value. So, of course, schools and ASDs were the biggest component of that, at about $16 per $1,000 of market value. And we'll come back, when I come back and looking at, after Mike Vaughn goes through the description of the system, we'll come back and look at what those rates are now and how they compare with that. Just to give you a sense now, currently our property taxes from all taxing districts collect about a little over $10 per $1,000 of market value. So from 26 down to 10. So if we look at the next slide and start to look at the process, the policy context by which we moved into this measures 5 and 50 and the passage of those two. One of the main things that happened in the late 70s, and this is one of the real tsunamis of state and local finance, was the passage of Proposition 13 in California in 1978. Prior to that time, in the whole post-war period, state and local tax revenues had been growing pretty significantly. A lot of it to finance schools, but a lot of it just to finance growth. So voters in California took a dramatic step. They imposed strict limits both on rates and on value growth. And of course, they did implement you were reassessed at market value when property changed hands. But as long as you stayed in that property, you were limited to very small growth in your assessed value. That same year, Oregon voters had a 1.5% property tax rate limit on the ballot, and they defeated it 52 to 48. So it was close in Oregon, but it didn't pass at that time. Now, of course, the legislature, they're very much aware of that pressure building. And in 1979, they went through with a major conference committee at the end of the 79 session that established a major property tax relief program, the PTR program, as it was known at the time. And the PTR program, the following biennium, ate up over 25% of the general fund budget. So the dollars were smaller than what we see now, but it's 25% of the state general fund budget was going to property tax relief. And this relief went to both homeowners and to renters. So it was a major program. This is not to be confused with the homeowners and renter relief program, the HARP program, which was established in '73 and continued beyond the PTR program. But the PTR was really a major injection of tax relief to try to head off a major property tax initiative. By the way, a little trivia note, that conference committee included a concept that nobody had really heard of at that time, something called the kicker, which they included in that overall package that was approved by the legislature and actually was submitted to voters a year later and approved by voters. In 1980, the voters had a 1% property tax rate and defeated it soundly. But those proposals, those initiatives kept coming. So between 80 and 88, there was a tax initiative. There were limits 3 more times that put on the ballot and defeated, some of them by very close margin. So we go to the next slide. And this is a kind of a continuation of the other. I couldn't get them all on one slide. Budgetary pressures, the early 80s, 81, 83 recession was a major recession. Oregon was one of the states most impacted by it. And what the legislature did at that time was look for places to make cuts, and the PTR program was extremely expensive, and that's where they made a significant decision to eliminate that program in 1985 after scaling it down quite a bit. The recession of that period and we actually had out-migration in Oregon during that period, only time in our history. We've had out-migration over a period of time. And that reduced those real market values statewide. And of course, if you're raising a levy, applying that levy to a shrinking value base, then you're gonna have to have higher rates to raise the same amount of money. Finally, we get to 1990, and by 52 to 48, Measure 5 passes. So this was the 6th try to get one passed in a little over a decade. And it finally made it and didn't make it by a lot. So, and that of course led to dramatic changes in the system. Now, did Measure 5 give the tax relief that people wanted? Well, if you look at the raw numbers, the tax relief was considerable. During that period from 1990 to 1996, property tax collections, not per capita, not real dollars, declined in dollar terms by 12%. So a 12% drop in property tax collections statewide over a 5-year period. Measure 5 is phased in. So a huge drop. Now, why weren't people happy with that? Why were they willing to vote Measure 47? Well, residential property taxes hardly changed at all. They stayed about the same during that period. So most all of that relief went to a non-residential property. And the reason for that was that at the time we had the net out migration in the 80s, Oregon was shrinking at that time. By the time we got to the early 90s, we had the recession in California, Defense Department winding down. Its expenditures really hurt the California economy. Out migration into Oregon, and finally driving up residential property values. So that market value increases offset those rate reductions for many residential areas. So there was dissatisfaction. The result, Measure 47, limited assessed value to what we see now, the 3% per year. And Mike will talk about that and how that works, but that was really the driving force. 47, of course, was really unworkable how it was passed. The legislature put together Measure 50 to make it at least a workable constitutional amendment that could be applied by property tax administrators. So that's where we got to, and that's we get to this Measure 5 world starting in 1990, then in the 97 with the limits on value growth. So before turning it over to Mike on the description, just a couple of things to go back to the beginning where we said, okay, what are the parts of the system that might be worth looking at as we look at some changes that might make sense? Well, I think one of them is the levy-based system. Maybe there's a way to incorporate a levy-based system that might be effective, not necessarily the one we had before, but to give more flexibility in terms of budgets. A second issue that may make some sense to come back to would be real market value, as Measure 50 has gone to a different value system. So again, Michael described that and how that works. And the third thing, and I'll get to this when we come back to the consequences for the state, is the elimination of the PTR program, and later the HARP program, the property tax relief programs, were one of the consequences of Measure 5 and 50. And should we look at, if you consider what your options are for overall reform, should we look at mechanisms to provide property tax relief that are needs-based to lower income and encourage people, help them with home ownership, and reduce the property tax burden on low-income individuals? So those are kind of the takeaways, and I'll turn it over to Mike for the description of the system.
Can I interrupt with a question?
Yeah, I was just going to jump in and say, please, we do have time for questions at the end, but if you've got some now, please go ahead.
Thank you so much for this presentation, Paul. It was really robust. I think sometimes, though, some of the language might need a little bit more explanation, like maybe expand what exactly a levy-based system means. Could you do that?
Sure. Yes, the levy-based system, as I say, we see it operational around a number of states in the country. But what you're doing, if you're, let's say you're a city council, you determine what your budget is. So you base that on, and like I said, the example I used was, let's say you determine that your budget is $1 million. So you take that $1 million, and the question becomes, well, what kind of a tax rate do I need to raise $1 million? Well, it's based on real market value. So you look at the real market value in your tax district, and let's say it's 100 million. So if your real market value is 100 million, I need to raise $1 million. You take 1 million, divide it by 100 million, you got 1%. So a 1% tax rate is what you would apply. Everybody would pay 1% of their real market value, and that would be the property tax that would be collected by the city in order to meet their $1 million budget. Now, if they wanted a $2 million budget, then they would have to have twice the rate, obviously. So it's the budget that you decide, and there's rules and mechanisms in which, limits on how much you can change that in a given year. For example, we had a 6% limit in Oregon that you could raise it by 6% without a vote. If it went over 6%, you'd have to go to the voters and say, we want this tax rate because we want to raise this much money. They would have the ability to negate that through their votes. So, but a levy-based system is figure out the budget. What is my budget? What is my tax base? And you divide that budget by your tax base, and that becomes the rate that everybody pays on their individual property.
I have a question. So are you saying, for example, a city, like the city of Gresham, they have the authority and the ability to increase their property tax rate by 6%?
Again, let's keep in mind, we're talking about the pre-Measure 5 world, so don't get confused where we are now. Yes, under that previous system, a levy-based system, was they could raise their levy up to 6% without a vote on an individual basis. Now, as I said earlier, I mean, 6% sounds like a lot, but in those days, remember, we had high inflation, we had strong in-migration, a lot of that period during the 70s. So a lot of the local governments were still under a lot of constraints because of high inflation and strong population growth. But that's the way the system worked, yes.
But that is not how it currently works.
No, that's our next phase. We're going to get into how the system currently works, and the interaction really between measures 5 and 50.
Thank you.
Any other questions for Paul before we move on?
Commissioner Jayapal, this is Jagjit. I have one quick question for Paul.
Yeah, go ahead.
Hi, Paul. Thank you for this awesome explanation. I just missed the third policy idea that you had. The first one was to go back to incorporating some form of a levy-based system. The second one was to go back to RMB. What was the third? Could you just briefly repeat that for me?
The third one is one of the consequences or casualties, or I want to describe it, of the Measure 550 was elimination of property tax relief, particularly needs-based property tax relief at the statewide level. Most states have something, whether it's a homestead exemption or what we call a circuit breaker that can provide some tax relief for low-income individuals paying high property taxes. And that was the third component is it worth looking at, maybe not going back to where we were in the 80s, but something that would provide some tax relief.
And if I remember correctly, this Representative knows, unfortunately, all of this is constitutional, right? So we have to change the Constitution to be able to do it.
Representative Knows, yes.
Hi, Dr. Warner. Nice to see you again.
Good to see you again. Yes, that obviously there. If you want to go back to a levy-based system, you would have to do that. But if you wanted to go with a property tax relief, you can look at different options that would be statutory. It wouldn't necessarily have to be constitutional.
And we will come back in the third session and sort of dive into, some set of more specific policy options as well.
Just one last clarification. Are we saying that would you agree that the levy system is by and large regressive?
Well, I don't think the levy system itself, Representative, I don't think it's regressive. I think the property tax is, in general, the way it operates currently and based on market value. And I'll come to that. This is my next section because I have a chart to where we estimate just how regressive it is. But the levy-based system is just determining on a rate that everybody would pay. And so under that kind of system, if you have, it becomes regressive, particularly for residential property, where if you have a low income and you're a homeowner, particularly in an area that's, have appreciating values for homes, you're very likely to be paying a higher rate than somebody that has more income relative to your income.
Thank you, Paul. Why don't we move on to Mike? Mike is our Director, Assessor, Tax Collector in Multnomah County. Go ahead, Mike.
Good morning. Okay, so my presentation is going to focus on the major changes that occurred in the 1990s. So where Paul left off in 1990 is Measure 5 and 50. So simply put, the laws that we're currently going to be talking about are found in Oregon's Constitution. I've copied a lot of those definitions that are inserted into my presentation. They're further clarified in Oregon revised statutes and then further administrative rules maintained by the Department of Revenue. So I've got some definitions I want to cover, but I'm also going to delve into the administrative realities of each of these concepts with examples. So if you're somebody who likes to see, like me, sort of the reality of how this works, hold on for a couple slides. But if you have a question and you want to jump in with that question as I'm talking, I'd be more than happy to answer within the slide itself. So just simply put, and this is kind of my area, property tax in Oregon is the product of multiplying a rate times a value. And 90s property tax laws with both Measure 5 and 50 limited both. So in the first slide here, we have the value, which is Measure 50, and three main values came into play with Measure 50. So the first is the definition is of real market value that and these are values that we maintain on every single property. So we've got over 300,000 accounts in Multnomah County. Each year we have to set these values. Real market value is, as Paul was just talking about, it's the value the market sets on a particular property. So there's no limitation. Values can go up 10, 20, 30%. Values can come down 10, 20, 30%. And if you've been around in the real estate business for the last 10 or 20 years, you've seen a lot of that. So it's a very simple, there's really no complexities to it. The second value, which really came about with the advent of Measure 50, is this concept of maximum assessed value. And there's two ways of looking at the maximum assessed value in the Constitution, which is property that existed in 1995 and then property that came into existence after 1995. And so for property that existed in 1995, now remember, the law didn't actually get passed and get administered until 1997. So, so basically it's in 1997, we took property that existed in 1995. We took the real market value of that property less 10%, and that became the maximum assessed value. This value is also, as it's described in the Constitution here, is limited by growth. So it can grow only 3% per year. With, of course, with that rule, there's any exceptions. We've got 6 exceptions in Oregon's tax system. I won't get into those exceptions in great detail, but I will kind of describe how they work as we move in through the slides. I will talk about the second aspect for property that came into existence after 1997 in my second slide. So I just kind of want to move into the third value that came about through the Measure 50 change, which is the assessed value. So that's the third value. Again, it's a formula, and it's simply described as the lesser of the real market value and maximum assessed value for property. So as we're doing our assessment work, each year we develop a real market value on a property, a maximum assessed value, and then we just decide whichever of those is the smaller number becomes the assessed value. It's important because that then is the value that's that's used to develop your taxes. So it's the taxable value. And I will note that there is no limitation on its growth. So this is where it gets a little confusing within administrative realities, is a lot of folks say, well, I've heard that the taxes or the values can go up more than 3%. There is no limitation on assessed value. It can go up double digits, and it has in prior years under various scenarios. And that's usually where we spend a lot of time talking about the realities of the administration of these complex laws. I don't know if Paul got into this deeply, but part of Measure 50 was supposed to create predictability. It was supposed to allow for limitation of value, which is part of the tax equation, and predictability. So from one year to the next, this is what the taxable value is going to be. However, in reality, that doesn't exist. We have seen and go through examples every year where a property tax bill will increase by double digits, values will go up by double digits, and so I would suggest that predictability doesn't always happen with Measure 50. So let's move on to slide number 2. So this is the example of property for the maximum assessed value that came into be after 1995. So the Constitution sets out a formula for establishing its real market value, or its maximum assessed value, for year 1. And basically what we're required to do is come up with a ratio, as the Constitution lays it out, of average maximum assessed value to average real market value for similar class property in an area. So we refer to that concept as the change property ratio. And that ratio in Multnomah County for the 1920 tax year is 0.49 for residential, 0.352 for multifamily, and 0.392 for commercial. So if you were to look at those ratios in terms of percentage, you would see that residential is about 50%, multifamily is 35%, and commercial industrial is about 39%. So as we're looking at these numbers, it's important to understand that with the limitations of Measure 50, we see further limitations on the lock-in of values that are created. So once maximum assessed value is created, it's limited to growth of 3% unless there is a physical change to property that occurs thereafter. So once we've established the MAV for 1 year, that's basically it. It grows at 3% per year. That's the limitation. Let's move on to slide 2, please. Okay, so all the definitions aside, here's how it works. What I've got is year 1, brand new apartment complex that has a real market value of $10 million. As we noted from the slide 2, the change property ratio for multifamily properties is 0.352 or 35%. So the way we establish the MAV for year 1 of new property is we multiply the real market value times the change property ratio to get a maximum assessed value of $3.52 million. Now, what's important about this is once that's established, that's established. That grows at 3% per year. And there is no ability to raise it above that 3% unless there's another physical change that occurs to the property. So the thing that you'll note from this is we already see that through this calculation that's ingrained in the Constitution, $6.5 million of value is being exempted essentially from the property tax calculation. This is usually where I get the question from policymakers to say, with all of the growth that's going on in Multnomah County, why is assessed value limited and not growing more exponentially? We see values exploding, and here is a great example. So when the property does become taxable, we have a limitation on the maximum assessed value or the taxable value that ultimately gets used in the tax calculation. So again, assessed value is the lesser of the maximum assessed value and real market value. So in this case, we would be basing taxes on $3.52 million. So year 2, how does that work? So now that we've already got our real market value and maximum assessed value, we just move that forward into year 2. So in this example, I've used the real market value of the complex goes up 10%. However, as we're calculating the maximum assessed value for year 2, we're limited by the Constitutional's 3% growth rate on the MAV. So the new taxable value becomes the 3.625 million. And you can see now where the disparity really starts to grow. We have a real market value now that's 11 million, and they're only being taxed on $3.6 million of that value. That becomes a problem, I would think, for a district, in that if you're thinking about a fire department that's providing a service to a particular property, it's not that they're only providing that service to 36% of that property. They're providing a service to the entire property. Water districts, sewer districts, these are all taxing districts that are required by law to provide that service. And so you already see the exemption that sort of has been created. The other thing to note is for investors with an understanding of this system, year 1 is the most critical to establishing the value and maximum assessed value of property. So almost every major development project for year 1 gets appealed, or we end up fighting in court over what's the value, because the investors know that if that $10 million valuation in year 1 could be $8 million, they're going to receive that benefit into perpetuity. And that often happens with tax reps year after year. So it's just the reality of how we've created this system that has these limitations, and we have folks who constantly take advantage of those limitations and create even more so a limitation. Okay, so let's move on to the next slide, which shows the more aggregate or comprehensive effect of the limitation. So I showed you in slide 3 how a particular account is affected by all these calculations and all these definitions found in the Constitution, but here's the reality. So you can see for 2019, the county has a total RMV of just under $177 billion. And going back to 2014, you see how that value has grown over the years in double digits. However, if you looked over at the assessed value for the county for 19, it's got a total assessed value of just over $77 billion. And you can see how it grows even during robust years of development and real estate growth at only roughly 4%. So if you're comparing the county-wide RMV with the county-wide AV, you see that roughly $100 billion of value is not being taxed. However, districts are required to provide those services. Before I move on, is there any questions about Measure 50 or the value or how it's administered? Okay, let's move on to the next slide. So on the rate side, what's important to note is that as Paul was describing how each district comes up with their operating budget, in fact, this is about the time of year that happens, each district submits to me a certified amount that they are authorized to collect. So districts are formed under specific Oregon revised statutes. Under those statutes, they're authorized to, on what they can levy. So what kind of operating taxes, local option levies, bonds that they're authorized to put forward. And so when a district has adopted their budget through the budget process, they send those to me in a certified document each year, again, right about this time of year. And so the three types of rates that we're talking about, or Paul was talking about in this rate-based system, is the permanent rate, which is established at the time of formation. So when the district is formed, they get a permanent rate, which is used to fund operating taxes. It is compressed. Local option levies are voter-approved options that usually have a time limitation of roughly 5 years. I think there are some that can go as high as 10 years. They're also compressed. And then bonds. So the three types of revenue streams, budget sources that ultimately end up as rates on a property tax statement. So Measure 5. So Measure 5 came in with limitations, and this was the first passage in 1990 that limited this rate to $5 per thousand of real market value. So just understand the distinction that taxes are based on assessed value. However, the limitation, because it was prior to Measure 50, is based on the real market value of property. And so this is why real market value matters. So for the limitation for schools, it's $5 per thousand of real market value. And for general government, it's $10 per thousand of real market value. So further on in this definition of Measure 5 that's come right out of the Constitution, you'll notice that there's the limitation itself, which is a test on an account by account basis. But there's further description of how taxes are proportionally reduced based on any property tax that exceeds that limitation test. Okay, so let's move on to an example that hopefully will bring all this conceptual stuff.
Can I just ask, sorry to interrupt,
Sure.
Mike, this is amazing. If we could just go back to the, I guess it's on here too. You're talking about the, it's compressed, not subjected to compression. Do you just have a concise definition? What is compression? How would you describe that?
Yeah, well, so let's move on to the next slide, and I think I'll be able to do that here really easily.
Okay.
So compression basically is the tax loss to a district because the tax that is attempted to be levied exceeds the limitation of the tax that's allowed by Oregon's Constitution. So in this slide, and I don't know if that's concise, I've been trying to simplify these concepts for 2 decades. And I don't know how good I am at it, but I keep trying. So that's why I throw in a lot of these actual examples, because I think they really sort of drive home how these concepts from definition to application actually exist. And the other thing I didn't say at the beginning that I wanted to is that a lot of these bigger concepts have worked themselves out through administration throughout the state. There aren't really any appeals of these. It's sort of known that this is the way it is, and everyone has accepted this. Usually when you get new laws set earlier on, there's a lot of court challenges and changes to how the laws are administered. That hasn't happened in over a decade. So we see here, this is an actual account in Multnomah County where we do the formula of testing. So we do this on every account every year, 300,000 accounts. And so you'll see on the left-hand category, left-hand part of the document, you see the categories of the 3 types that I had referred to in the compression or the limitation test, which was education, general government, and then all of those rates that are excluded from the limit. Moving down the columns to the right, you'll see the tax rates. So these are the rates that are sent to me by each district in their budget process. So they send me their budget document that says, in some cases, they say, here's the rate, extend it to on every property. In other cases, they say, here's the money we need, you calculate the rate. So it just depends. But you'll see here in the first category of the education, they said that we want this is all of our rate. And we apply that rate to the value. On this particular property, it's a commercial property that has a value of $11.5 million and a maximum assessed value or taxable value of just over $3.2 million. So we extended the taxes that the district asked for on the assessed value and came up with, we call it the extended tax or the pre-compression tax. And if you kind of scroll down a little bit, I don't know if you can see the whole screen there. Angela, is there any way to kind of push it down? Oh, no. Okay, I'll just summarize. At the bottom, it shows that, yeah, unless you shrink it maybe a little bit, it's my fault for trying to pack too much information in there. At the very, very bottom, there's a summary. So the consolidated tax rate of all the tax rate is 25.34. The total taxes extended on this property is, if you add up the pre-comp taxes, is $287,000, just over. So then we do the compression test, and that's the third and final column. And we apply for education the $5 per thousand of real market value. So it has a real market value of $11.5 million. We do the math. It shows you that with compression, there is a loss for every district rate there, adding up to, for education, it's a loss of tax. This is compressed, so compression, $25,372. That's the amount of tax that we will not collect because it exceeds the constitutional limits that are put in place. General government, going down the column, $169,450 was the tax that they needed to get for their budgets. However, due to the compression test, they were not able to collect $54,450. And then bonds are listed as excluded from the limit. There's obvious reasons for this, just at a high level. A bond levy is simply what the district needs to collect to pay the principal and interest for the coming year, right? So if there was a limitation test on that, then the bonds wouldn't be paid, bond ratings would decrease, and there's a potential that lenders wouldn't even buy bonds because there is the risk of not collecting annually the money you need to pay for the bond itself. So what you can't see at the very, very bottom, which is cut off, is, as I said, the total taxes extended, or what the districts thought they were going to collect, was just over $287,000 on this account. But due to compression, which totaled just under $80,000, the total taxes levied, or the tax statement that the taxpayer received, was just over $208,000. So you can see nearly $80,000, and this is just one account. Commissioner, did that get to the heart of your question of definition plus showing you how it works?
Yes, that is I think the closest that I have seen.
This is Lori Monis Anderson. Could I just cite an example, because Gresham really gets screwed, especially from Measure 50, not so much from Measure 5. But we out here have a tax rate of $3.61, and that's one of the lowest ones in the state. It's literally half of what Portland's is. And so we never really reach compression. And so we end up paying more from regional services like the library, when the Multnomah County Library District we proved that we on average pay almost twice as much as Portland residents because Portland residents hit the Measure 5 compression sooner and have their rate reduced. It also means that Gresham is started for revenue to provide critical resources. We're prevented from providing critical resources because in 1990, property taxes in Gresham covered 100% of the cost of police and fire, but today property taxes don't even cover enough to fund the police department alone. So this is an extremely important issue, at least for East Multnomah County residents, that has to change because the inequities between Portland and Gresham is astronomical in our views. And I just sent some documents to Lori Stegman that I have so that, and then I think I'm going to, Paul I think already knows this. I've talked with him a lot about it, but I think I'm going to send what Gresham has given me to Mike, to you, Mike, also. That's my 2 cents.
Yeah, it's very well understood. And I'll talk about it on the next slide, but there's an aggregate amount of compression loss. But I want to finish up with this slide because I think there's another point to the predictability and the concept that it's knowable from year to year and my taxes only go up 3%. These are all the misnomers that I constantly hear in the tax office year after year. So this is an account that they have, the total taxes they should have paid was $287,000, but due to the compression test, was reduced to 200, just over 200,000. And what's important to note is that this account has been adjudicated by the courts, and it's possible that when it comes out, which is, so an adjudication is when a court says the value is lower than you have on the roll, and the statutes require me to lock that value in for 5 years, and I really can't do anything to change it until that 5 years is up. So let's say that really we think that this property is worth, let's say, $20 million. And so year one, or the end of year 5, year 1, it comes out of adjudication. It has a real market value of 11.5. You see they have $80,000 of compression that's reduced. Their tax statement's $200,000 year 2, comes out, value goes up. We do the compression test and all of the taxes are levied. So their tax bill goes from $200,000 year 1 to year 2, it's $290,000. This happens all the time, and not because of the tax court. There's other reasons for property owners, residential property owners, where their tax bill has now gone up 30%. And we get the call that says, where's the predictability? What happened here? There has to be something totally wrong. And we have to go through every year sort of explaining this is administrative reality of the system, and there is no such limitation on tax growth. It can go up, as you've seen, 20, 30, 40% for a lot of different reasons. It could be a new local option levy that was passed. It could be compression coming off an account that had it prior. And this is where residential property taxpayers really are affected, because they're not understanding this because of how nuanced and complex it is. And the predictability, again, that was supposed to come about due to all these law changes and limit to all the government and revenue, which it did, but it really missed the target, I think, on the predictability, because this is what happens year after year, especially in up markets and markets where you saw down years and up years, you see that as well. So let's move on to the last slide and then I'll finish up. So total compression loss for Multnomah County, and that's for all the districts, was just over $78 million for 2019. That's a big deal. Total exemption, I always bring into the discussion because it really talks about the revenue picture. So total AV that was exempted, this is taxable value from Multnomah County, was $11 billion last year. This is a number we report to the state for their overall report. When you're talking about a total countywide value in real market value terms of over $170 billion, $11 billion isn't a lot of money. But when you're limited on the taxable value that can be used for the basis of tax statements and revenue for the districts of $77 billion, $11 billion now becomes something above 10%, 12, 13%. of the total that could be taxable, however, is currently being exempted. I bring this up because every single session, my office spends most of our time dealing with tax exemption concepts that come out of the legislature. And every year we see new exemptions being added. And I don't know that I really am brought into the conversation about what's the total effect to the districts themselves. And I just thought I'd throw this out as this is the reality and the aggregate amount that is not currently being taxed due to exemptions ongoing and those that keep getting created. Access to property is another challenge we have in the assessor's office. So roughly 25,000 properties are visited each year. There are no laws that require access to be given to a property, and something less than 30% of those accounts that we visit actually give us access. So in a lot of times we have to make guesses from the road on what's going on. A new house gets built, we have to guess what's the inside of the house. These are all limitations to us getting the values right and making sure that the ultimate taxable value is correct so the districts get the right amount of money. Most would argue that RMV becomes less important when you're dealing with the maximum assessed value. However, it's real important in the year one and when you create the maximum assessed value. So I would suggest that RMV is as equally as important. However, ongoing, it may not be. So from one year to the next, there may be a deprioritization of the value of RMV, but if you're talking about compression or new property, it's highly important. Chasing exception is critical. So we have 300,000 accounts in the county and over 25,000 new accounts that we're looking at, or not new accounts, but changes to existing accounts, maybe new accounts. And we want to make sure that we're getting the values correct so the taxes that are being assessed and distributed out to the districts are accurate. So with that, I'll stop talking and take any questions that might come up.
If there aren't any additional questions, we'll move on. And I'll just note that we're running a little bit behind, and I want to be respectful of your time. But if you have questions, it's important to ask them, and we can always be flexible. And if we need to, perhaps move the last session over into next week. So don't feel free that don't feel like you can't ask your questions. With that, we'll move on to Jeff Renfro and Vanessa Elkin. I'm sorry, I got it wrong. We're moving back to Paul.
Thank you, Commissioner. Yeah, I'm just the idea here is just to give a very brief overview of some of the statewide consequences of this system that Mike has explained to you. Very complex, obviously, but also has had some major macro impact effects on our state and how our state public finances work. First of all, one of the major issues around the pre-Measure 5 world was high property tax rates, and that was clear from looking back at the rates of that time, and lower overall property tax burden and reduction in property tax revenue, of course, the other side of the budget, have been two very clear consequences. And we'll take a look at that in just a second. The other thing that we mentioned earlier was property tax relief played a prominent role in Oregon's property tax system, particularly in the early 80s, but then on into the late 80s, that basically got taken away by Measure 5 as a kind of a general property tax relief rather than focus on specific needs-based property tax relief. And finally, just to take a quick look at an issue that came up earlier about who does bear the burden of the residential property tax and where do we think it falls when we look at that across the income spectrum. So if we look at the first slide, the next slide, you can see this. I mentioned earlier that the property tax burden was about 5.1% of personal income in 1989 when Measure 5 passed. So, but if you go back to the early 70s, it was almost 6%. So in the 70s, we had very high income growth because of inflation, and that depressed it somewhat. But you can see that the tax rate at 5.1% dropped. It dropped in over a 5-year period because of Measure 5, and reached its bottom in 1997 of about 3.2%. It's crept up very slightly since that time to about 3.6%. Well, you put it in those percentage terms, you think, well, gee, 5.1%, 3 point, that's 1.5%. Why is that such a big deal? Well, total personal income, measure of Oregon's overall economy, is about $200 billion a year. So you take property taxes that went from 5.1 to 3.6% for 1 year now, in today's dollar terms, that's $3 billion a year. That's the differential in the amount of property tax relative to our economy that's being raised now compared to what it was in 1990 prior to the initiatives. So a significant drop in the property tax burden over that period of time. And of course, a huge impact on overall budgets. So if we look at the next one, the next slide, property tax relief expenditures. I mentioned the PTR program in the early 80s. You can see it was 250 million. As I mentioned earlier, that was about 25% of the general fund budget, a huge commitment by the state. That went away. And then you had just the homeowners rent relief program, the HARP program, that lasted to 1991. That was very constrained by income standards required. And then that was eliminated. So now, basically, beginning with the early 90s, there's no major property tax relief, needs-based property tax relief program in Oregon. These numbers here exclude what's called the Senior Property Tax Deferral Program. It's also for disability relief program too, which allows people to defer their property taxes if they go into the program. This program had reached a level of $20 million in terms of property tax relief back by 2010. It's now a little over half that size. We had a major crisis in the program during the housing crunch, and many people got overextended. The program itself couldn't fund itself at the levels it was at, and so it was scaled back. So even that program's dropped from about 20 million a year down to about 12 million now, so a significant drop. So again, property tax relief expenditures are not a major element of the current system. Look at the last slide. This slide is results from the work that from the what we call the tax incidence model that Legislative Revenue Office developed years ago, and it was updated and maintained. And one of the goals of this model is to try to look at who actually bears the burden of different taxes. When we look at the overall state, for example, it's kind of a bowl shape, and you can see from these individual taxes why it is. By that I mean that there is a regressive piece to it at the low end. As you come from the less than 21,000 up to the 20 to 30,000, you see a drop in tax burden. That's a regressive component. But if you get out toward over 200,000, you see there is a bump up in the tax rate. So Oregon has, in the middle, it's largely proportional, so that our taxes see a regressive at the low end, about proportional, meaning people pay about the same percent of their income in taxes. These are households. And at the high end, you see a bump up. The bump up at the high end is due to the personal income tax. And you can see the blue line there. And the personal income tax over the last 10 years has definitely been made more progressive through the policies of the legislature. Things like, for example, adding a new rate of 9.9%, phasing out the federal deduction based on income. So all of those things have pushed that rate up in the high end and added a progressive element. But overall, the system's largely proportional. With the lower end, you have this regressive component. One thing I might add, being proportional seems like a normal kind of standard. For state and local governments, it's not. Most state and local government tax systems are regressive overall. And this is primarily due to retail sales tax, the way that is so important in a number of states. But Oregon, largely proportional. But I wanted to finish with a discussion at that lower end. And you can see that orange line. What we're saying is that people in the households in that less than 21,000, very low end, are paying between 3.5% and 4% of their income in residential property taxes. And you drop to about 2% for the lower middle income folks. So it's that very low end that has a high effective tax rate. By the way, when we separate between residential and non-residential property taxes, homeowner occupied residential property tax for about 55% of property taxes. And when you throw in multifamily, it's about 62% of total property taxes. The other 38% we throw into this category for this model we call business property taxes. And that's, as you see in that gray line there, there is some higher impact at the very low end there. This is largely through what we call the excise effect, which pushes prices up for some consumer goods, and that ends up resulting in a regressive element. But then that's largely proportional. And then as you get toward high income group, that becomes a progressive tax too. And that's largely because it's a tax on capital. And capital is distributed much more heavily toward the high end. And so that's where you see that those two elements both curving up. Now, getting back to the residential property tax, who are these folks? Well, part of them are renters, certainly. So the renters there have, we assume, are bearing the burden of the property tax that's imposed on the owners of the property. But it's also a large group of that is seniors who have low current income who are owner occupied. So those two groups are really the ones that are bearing that burden of the property tax. So if you look at this overall system, where you see the regressive element come in, it's on the residential property tax side, and it's at that low income component. So again, this gets us back to raising the question, can our tax system do some things to alleviate that that regressive element of the residential property tax? So with that, I'll turn it over to Jeff and Vanessa to take a closer look at the Multnomah County numbers.
Can I ask a quick question?
Sure.
And maybe this will be most relevant in going county by county, but I also think it is important at the state level as well. Is there a breakdown? You know, you talked about elderly folks living on fixed income. Is there a breakdown by race, ethnicity, so that we're able to really clearly view some of those disparities that I imagine exist in this system as well?
That's an excellent question. I know there's been some work done in that area. This particular model is it's a statewide model. It's what we call a computer general equilibrium model. So it doesn't do that, but I think you could certainly go there by looking at some of the census data and breaking it down where home ownership is. We do know that home ownership, you have that segment that's elderly that are over 60, over 65, that, you know, they kind of age in place in their homes. And they, of course, are their income now is not very high, but their property taxes are high. There's also obviously a regional component here where we have areas that have higher taxes than others are likely going to hit that group more. So yeah, I think that certainly some more work can be done in that area, and there's probably been some good work done there that I'm not aware of right now.
Great, thank you. Thanks so much.
Thank you, Paul. I think we will try to go ahead and finish up, and then we can always come back for some more question time next week. And as I mentioned, you can also feel free to put your questions in the chat and we will get back to you. We move on to Jeff and Vanessa for implications for Multnomah County.
So I'm Jeff Renfro, the economist at Multnomah County. So I'm going to talk about some of the practical implications of all of this. So at the county, we tend to talk about structural deficit. So to sort of oversimplify what the county does, in essence, we collect taxes on one end, and then we use that tax revenue to pay people to implement county policy. So in any given year, our financial position can be best explained by the comparison of our rate of growth of our revenues compared to the rate of growth of our personnel costs. And what we find is under normal circumstances, we expect the rate of growth of our personnel costs to exceed the rate of growth of our revenues. So a lot of that is due to limitations in our property tax system. So this first graph, this is the same thing that Mike showed you earlier. This just goes back a little bit further. The red line is real market value in Multnomah County. That blue line in the middle is the assessed value that our tax rate actually gets applied to. So what you can see is going back to 1999, real market value in Multnomah County has tripled, while assessed value has gone up by a little bit more than 50%. So what that means is, as Mike alluded to earlier, even with the sort of huge increase in development in Multnomah County, the double-digit year-over-year increases in property values, our assessed value and our revenue associated with property taxes continues to just inch up. So we do benefit from that development, but because of the change property ratio that Mike mentioned, it's just not to the degree or the magnitude that I think most people would expect. So if we could go on to the next slide. So to come back to this structural deficit discussion, so the dark blue line is our year-over-year revenue growth going back to 2003. The light blue line is our labor cost growth. So it's pretty messy here, but basically, as I said, under normal circumstances, which I'm not sure there's never actually a normal year, we would expect cost growth to go up faster. So I'll talk about the exception to that first before I come back to what the normal circumstance is. So you can see starting in 2013 going through to about 2018, that dark blue line, our revenue growth was actually higher than our cost growth. So the circumstances that led to that were pretty unusual. So coming out of the recession, our business income tax, which is normally pretty volatile, we had a decade of just sustained growth. Also, we had our motor vehicle rental tax, which is our third biggest revenue source, more than doubled during that period. And a lot of that was due to just increased popularity of Portland, more people coming through the airport and renting cars. And then on the cost side, coming out of the recession, we had a period of very low inflation, which inflation is what feeds into our cost of living adjustment in our labor contracts. So a combination of exceptionally high revenue growth from our non-property tax revenues combined with low inflation meant that we had a period where our revenues were growing faster. But then as you get to that right side of the graph, even before we get to the recessionary impacts associated with the pandemic, you can see us flipping back to normal with a sort of normal level of inflation at 2 or 2.5%. Or we've actually had fairly high inflation in the last couple of years, but getting back to a normal level. And then BIT starting to come down, motor vehicle rental tax settling out at a 2% increase year over year. We're back to a position where generally our deficit is just going to increase by a little bit year after year after year. If we want to go on to the next slide. So Vanessa and I are going to talk about a little bit of the inequities that result from the current system. So I'm going to talk about the vertical inequity, so differences between different levels of income. So this is a pretty busy map, so I'm not going to expect you to look at different parts of it, but just sort of absorb it like an impressionist painting here. So this shows the ratio of assessed value to real market value for residential properties in Multnomah County. And the sort of darker blue, the cooler blue colors, are properties where the assessed value to real market value is most distorted. So assessed value relative to real market value is the smallest. As you go east on the map and you get into the warmer sort of greens, yellows, and reds, those are the properties where assessed value is closer to real market value. Right? So implication of this is, as Mike said, the rate that we're using is actually applied to the assessed value of a property. So it has implications for the tax that an individual homeowner is going to pay. And then it also has implications for capitalization, which I'll talk about in a second. But the pattern of how this develops is, so as Mike said, AV can change quite a bit from year to year. But in general, you would expect AV to just continue to bump up at that constrained rate, whereas real market value is going to change with the property market. So the areas where the greatest distortion occurs are the places where real market values have changed the fastest relative to those 1995 values when assessed value was initially set. So if you look in the northwest portion of the map, you see that dark blue area. That's kind of the Mississippi, Vancouver area. It's generally areas where gentrification has been strongest. And then also as you get further south on the map, these sort of closer in areas where property values have gone up the fastest, those are the places where real market value has run away from assessed value at a faster rate. As you get to East County, real market value just hasn't gone up as fast. So your assessed value is going to end up closer to your real market value. If we want to go to the next slide, we'll see a practical consequence that follows out of this. So this is looking at just the tax bill that you get in the mail from Mike's office compared to the real market value of the property. So because you're paying, most of your tax is going to be based on that assessed value, the actual amount that you pay relative to the value of the house is also going to be distorted by that ratio of assessed value to real market value. So what that means is that people who live in areas where their assessed value is closer to their real market value are paying a disproportionately high share of the revenue that comes into governments relative to the value of their property. So what makes this a little bit complicated to talk about is people who live closer in general tend to pay higher taxes in terms of actual dollar amounts, but that tax amount relative to the value of their property is usually going to be smaller. So it requires you to sort of incorporate a definition of fairness into kind of what people should be paying relative to the value of their property. The other thing is this isn't necessarily tied to income, but over time, people with higher incomes are going to be able to buy the properties with higher real market values. So the system is going to get sort of more inequitable over time. It might take years or decades for that to fully play out. But what we can already see is relative to the values in 1995, those areas in sort of the inner part of the city where property values have gone up the fastest, those people are getting, in essence, the best deal. They're the ones who are paying a tax bill that is smallest relative to the value of their property. I'll go on to my next slide. Another implication of this is that before I worked at the county, I worked at the Northwest Economic Research Center at Portland State University. And we did a study where we looked at capitalization associated with these inequities. So in essence, what this means is that in properties that have a more distorted assessed value to RMV ratio, the places where those values are furthest apart, people are actually willing to pay a little bit more for those properties, all other things held constant. So to put that into really plain language, if you imagine you have two houses that are identical in every way, the only difference being that their assessed value to real market value is different, which that could happen based on the value of the property in 1995. We would expect a person buying the property to be willing to pay a little bit more for the house with the lower AV. And the mechanism there is that when people are purchasing a house, they're thinking less about the actual value of the sort of total price tag of the house, and they're converting that into, well, what is my monthly cost associated with housing going to be? So if you incorporate what you are going to need to set aside for your property taxes, if you have a greater distortion for assessed value to real market value, your monthly set aside for your property taxes is going to be a little bit lower. So you're going to be willing to pay a little bit more for your mortgage, right? So that will translate into willingness to pay a little bit more for the overall value of the house. It's similar to what happens when interest rates fall. So when interest rates fall, there's usually a little bump in home values, because at the same price, people's monthly payment is going to be a little bit less with lower interest rates. So overall, what this represents is a transfer of value from the public sector to the private owner, right? So because people are getting a little bit better deal on the property that they own, that makes it so their house is a little bit more attractive to the buyer. The buyer is willing to pay a little bit extra for their house. That's the transfer from public sector to private ownership. So because we're a little bit short on time, I went through that very quickly. As the commissioner said, I'd be happy to take questions. Probably not now, but at a later date, and I'll hand it over to Vanessa to talk about horizontal inequities.
Great, so thank you commissioners and legislators for your time. Jeff laid it up really well, so I'm just going to show kind of what that horizontal inequity looks like on a regional level. And I'm going to start by first showing two homes. sold within a year of each other in 2019 and 2020 for virtually the same amount, just $6,000 difference. They were sold for between $749,000 and $755,000. The house on the left is located in Northeast Portland, Northeast 10th. The house on the right in Southwest 28th. When looking at the assessed value, you can see they're very different. The left house has a ratio of assessed value to real market value of just around 15%. In comparison, the house on the right has a ratio of 100%. So why is this happening? Jeff and the other presenters explain this, but a lot of this has to do with the Measure 50 locking in place assessed values at 1995 levels, and then allowing only 3% increases annually. So on a regional level, in neighborhoods where market values have increased dramatically, such as Northeast Portland, homeowners might be paying taxes on less than 20% of their market value. In neighborhoods with more consistent or stagnant market values, even homeowners might be paying taxes on 80% of their market value. And this phenomenon is called or described as horizontal inequity. If you want to go to the next slide, we can see what this looks like on a regional level. In 2017, we see, each blue dot represents a home with an assessed value versus real market value ratio of below 20%. So most of these are concentrated in Northeast Portland. There was a total of 3,655 properties at that time that had this ratio below 20%. Again, mostly in Northeast Portland. In the next slide, you can see this has been updated now to show 2019, and the blue dots have increased, right, from up to 3,818 homes just in 2 years. This isn't happening, I should note, just in Multnomah County, however. The Oregon Legislative Review Office published a report in 2010 that looked at horizontal inequities under Measure 50, and it looked at property tax records for Multnomah County, but also Deschutes, Jackson, Sherman counties at the request of the Oregon Senate Finance and Revenue Committee. And it found that, while Multnomah County is experiencing the most acute degree of horizontal inequity due to its larger, more diverse housing market, there's inequities widespread throughout the state, and they occur throughout the price spectrum. And then the next slide is that, it's not just having an issue of fairness and who's paying for these taxes, but it's also causing gentrification of areas, and it's overlapping in, again, this Northeast Portland area where there's lower ratios. We've seen increased gentrification between 2000 and 2016. People of color have been displaced and decreased in Northeast Portland during that 17-year period. People of color decreased by 57% in Northeast Portland. It increased in east of 82nd by 98%. The white population increased in Northeast Portland by 48%. So that looks like in every, each year in the blue area, 970 white people have moved into this area on average, whereas 570 people of color have moved out. And beyond just movement of people, what this means is, people of color are having to move farther away from community resources, adequate public transportation, career and educational opportunities, and just their home communities. So this has a lasting impact on these people's ability to thrive. So that's my presentation in just a few minutes, but if there's any questions, just let me know.
Thank you so much, all of the presenters, Paul, Mike, Jeff, Vanessa. It's a lot of information, a lot of really important information. We've got squeezed for time here a little bit at the end, but as I mentioned in the chat, I know, please feel free to send questions to us, and if we'll go through and see if there are questions that we can answer in the meantime. Looking forward to seeing you all next week. And what we're going to do is, add some personal narrative to the data that you just saw, especially those last slides, the ones that Vanessa talked about and that Jeff talked about, when we think about the way that the property tax structure is overlaid on displacement, on gentrification, on specifically the displacement of Black and Brown folks from North and Northeast Portland and other parts of Portland farther out, really to add some more personal narrative to that. The data points on the map are data points, and behind each of those data points is a story. So we'll try to bring in some of those stories, and we're also going to have Mark Garst come and talk more specifically about impacts in other counties, so we get a sense of that complexity. And then, as I said before, the third session, we will walk through some concepts and have some discussion. So again, thank you all. Thanks again so much to the presenters for all that great information. If any of you who've attended and watched have suggestions or other things that you're interested in talking about, please reach out and let us know, and we'll do our best to incorporate that into the next 2 sessions. So thank you all. Have a good rest of the day.